This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 174 was pre-recorded on July 3rd, 2019 for release on July 4th, 2019 when fireworks will celebrate independent... No, wait a minute. It's 3,000 on the S&P that those fireworks are celebrating. In any case, I'm Erik Townsend. This episode of MacroVoices is brought to you by TopTradersUnplugged.com, the leading podcast when it comes to systematic trading and investing. Due to the U.S. holiday, our market commentary will only be current through noon on Wednesday, July 3rd. Author John Netto joins me as this week's feature interview guest. We'll discuss current market drivers and then move on to some bigger picture topics, which John covers in his book, Global Macro Edge. We'll have an abbreviated postgame segment this week with a quick chart book update on a number of different charts, particularly the S&P 500. Holy cow, folks, 3,000 on the S&P. Who would have seen that coming? Oh, yeah, we did.
And I'm Patrick. So, Erik, let's get right into that S&P. You've referenced it now twice, the 3,000 level. We're right on the cusp of it. Obviously, a really bullish reaction after the G20. What's your take on all of this?
Well, I've been thinking, Patrick, once the China deal is done, and I'm convinced we're going to get some kind of China deal. I don't know if it's going to be a good, bad, or indifferent one, but we're going to get some kind of deal. Both leaders have too much at stake to let this fall apart to just go to no deal. And I think we're going to get a rate cut. Was it 25 or 50 basis points? Well, we'll see what happens. Okay, after those things happen, what's left to drive the next leg higher after that? Well, one answer is declining interest rates, fueling even more stock buybacks. But at what point are Democrats going to begin trying to intentionally sabotage the economy in the run-up to the election? And what are President Trump's options to defend against that? So I think that there's a case to be made for a summer rally, maybe a September rollover, and the potential for an October massacre. That's one plausible scenario. But I also see an entirely plausible scenario for a melt-up fueled by declining interest rates, which, of course, support more corporate buybacks, and Brent Johnson's scenario. If Brent and I are right that the dollar index is going to continue to move higher, that really creates a strong incentive for foreigners to pile into U.S. equities. So the viewpoints that I think are most important to understand right now are the contrast between Brent Johnson's view versus Danielle DiMartino Booth's view, which we've interviewed in very recent MacroVoices All-Stars episodes. So let's come back to that in postgame where we can go into a little bit more detail. But I think that's kind of the trade-off. I could see it going either way, but boy, the daily close above 3,000 hasn't happened yet because we're recording before the close on Wednesday. Sure looks like we're headed there, and that would be a sign that maybe much higher numbers are still to come.
Well, let's move on to that dollar index because you just referenced it and the fact that you're still bullish. And I'm bullish on the dollar as well, but certainly Donald Trump seems to be talking that down. Where do you think the next move on the dollar is then?
Well, he's trying his hardest to talk it down, that is for sure. But as I look at this dollar index chart, what I said last week is it looks like it's bottoming out where it was last week and moving higher. And sure enough, it has broken considerably higher. What I also said last week is be careful, though, because we could be seeing the beginning of a new downward sloping price channel. And if that was the case, we should expect a rally up to about 96.60 or 96.70 on the September contract, and we could then see a rollover to lower numbers below the recent low, right around 95.50. If that were to occur, if we moved to new lows and it seems like a downsloping price channel is in effect, that would really cause me to have to revisit my view and think, okay, maybe I got this thing wrong. So I'm really watching carefully to see, first of all, can we get past that 96, 70, 75? Let's call it 97 just to be really safe. If we get to 97 on the September contract, we're not in a downsloping channel, or if we were, we've broken out of it to the upside. And I really think that the bull case is on. If we move to new lower lows below the recent lows, okay, I got to really question whether I got this thing wrong.
Eric, let's move on to crude oil, because the first reaction after the weekend was actually a breakdown, rejecting the $60 level and heading back down. Is this a new breakdown in oil from here?
It sure looked like it, Patrick, until Wednesday afternoon. And again, I want to emphasize we're recording before the pit close at 2:30 on Wednesday afternoon. So the jury's not completely in yet, but it sure looks to be. Very, very interesting action. Let's start with inventory. EIA data reporting this morning, crude oil drawing down 1.1 million barrels. Now, that's a drawdown, which is normally a bullish signal. But API had expected more than 5 million barrels on that drawdown. And needless to say, this wasn't anything close to that. Meanwhile, Cushing, Oklahoma, building 652,000 barrels. So there was a build in Cushing despite the nationwide drawdown. The nationwide drawdown not nearly as big as everyone expected. Gasoline drawing down 1.6 million barrels, but that's almost completely offset by a build of 1.4 million barrels in distillates. Now, the tape action was down hard in reaction to the data in the seconds and minutes afterwards, and we moved back down to the low of the day, but only to the low of the day on the crudes. And then something really bizarre happened, which is RBOB gasoline really started taking off to the upside. Now, why would that occur? Certainly, if you had a situation where there was a refinery, fire or outage or something that would cause gasoline to be in extreme demand and reduce demand for crude oil, as happened with Hurricane Harvey, or as would happen if there was, a disaster at a refinery someplace, that would make sense for gasoline going straight up even while crude oil is down. So for quite a while today, we had a very unusual situation where RBOB gasoline was trading above all three of its short-term moving averages, the 5, 8, and 13-day simple moving averages. That is bullish uptrend conditions. Meanwhile, WTI crude oil was trading below all three of its short-term moving averages. That's bearish downtrend conditions. Well, they can't both be right unless there's some major refinery outage issue, and I don't see anything in the news to do that. So it created a tug-of-war between the bulls and the bears. Is RBOB gasoline going to pull the crudes higher, or are the crudes going to pull RBOB gasoline lower? As we are recording right now, Patrick, it is still about 45 minutes before the pit close on Wednesday. RBOB looks so far to be very clearly winning this tug-of-war. We've moved considerably above the 5-day on RBOB, and now crude oil has been pulled above its prior high of the day, and we're looking at more than $57. So it looks like what's happening is, so far, all indications seem to be that yesterday was a bear trap and that we are going to see a retracement higher in prices, something I was definitely not expecting. So it'll be interesting to see. Again, we did record this before the close. The jury's not in quite yet, but it looks like gasoline is pulling the crudes higher as we speak today. U.S. production ticked back up to 12.2 million barrels. That's particularly important because we were concerned that maybe there was a new trend of gasoline production moving lower. I've been saying, watch, if it drops below 12 million barrels, we need to start to get worried. Well, it's ticking back up. It's only 200,000 barrels off of its all-time high of 12.4 million barrels. Imports were up this week. Exports were down. That probably explains some of the reason that we didn't see as big of a drawdown as a lot of people expected. Now, something that Pippa Malmgren kind of set me straight on in her All-Stars interview, which will air on Friday morning, July 5th. I've been thinking about the geopolitical risks in this market probably the wrong way. My thinking was, as much as John Bolton very clearly wants to go to war with Iran, if I'm reading the tea leaves correctly, I think President Trump really can see that getting into a war just as we're coming into election season doesn't make any sense. And I've been kind of discounting. I think President Trump is not going to let that happen. Pippa pointed out to me, don't assume because it's an election year that means a president doesn't want to be at war. War conditions generally cause the population to become patriotically aligned behind the president, even when they wouldn't normally support him. So it's not a good assumption that because it's an election year, President Trump will be inclined to avoid any kind of military conflict. So I want to thank Pippa for reminding me about how some of those dynamics work. My view has been that unless there's new news to push the market higher, that what we're going to see is a resumption of lower prices. And that's exactly what we were seeing until this afternoon. I really don't know what got under gasoline and got such a bid going. But so far, gasoline is leading everything higher this afternoon. It makes me think there's news that I don't know about yet. In any case, we'll see what happens as this develops in coming weeks.
Well, let's move on to gold, because I thought Monday we were going to begin some sort of a throwback correction, and suddenly we find ourselves here as we're recording the stone's throw away from breaking to a fresh high. What's the next move on gold?
Well, I've been back and forth, too, on this, Patrick. At first, when I saw the size of this breakout, even though, it basically is proving me wrong, I didn't see this one coming. I was thinking, okay, looks like this is the big one, like we're really seeing a breakout. Then that sell-off that we saw and the gap down open, and the market just didn't seem to want to close that gap. It really said to me, like, maybe this is a fake breakout. We're getting ready to trace lower. Now, Tuesday this week, we saw a huge spike right back up to the previous high, right around 1440, whatever that number was. And, I thought, boy, that sure looks like it's game on and we're moving much higher. But then I read the news and discovered that move seems to have been inspired by President Trump nominating Judy Shelton as a Fed governor. Now, I certainly support the idea of Judy Shelton, a Fed governor. Imagine that, someone sitting on the Fed board who believes in sound money and doesn't really buy into the religion of fiat currency that so many other central bankers share. But I don't know what people are thinking if they think that President Trump nominating someone who is likely to see great opposition and probably will never make it onto the Fed board, if they did, it would be just only one voice. Why would gold suddenly go up in price dramatically just because one person who maybe believes in a gold standard might have a slim chance at maybe being a Fed governor who would be outvoted by everybody else? So what I said last night as I was making notes for today's show is I think this is a setup for maybe a retrace back down for this big move that we saw. And as I look at the tape this afternoon, we've seen almost half of that big move up retrace down, not all of it yet. So I think the jury is still out. I would still say the preponderance of evidence is probably that this breakout is real and has legs, but I do still see a very distinct possibility that we could be in a little bit of a panic situation that's eventually going to blow over, and we're going to see a retracement lower back down towards 1350 again. Time will tell, and I certainly have to handicap myself because this breakout is something I didn't see coming. I was very skeptical that it would occur, and I've been proven wrong there. So we'll see what happens next.
Well, let's finally touch on the 10-year Treasury yield, because after consolidating at 2% for over a week, we finally had a break and we're down decisively below 2%. What are you thinking here?
Well, what I'm thinking is I sure wish the break went the other way. I've been waiting for some kind of pullback in price or backing up of yields just to get onto this long trade. Because as you remember, several weeks ago, I said on this program, folks, pay attention here. We're retesting 2.60 here and now. This is your buy the tip moment. Well, I said that to you. I didn't do it myself. The reason I didn't do it myself is I already had a significant position long the 2-year. Needless to say, the longer duration risk would have been the place to be, and, so it is. I've been waiting for a significant pullback so that I can buy the dip and get in on this move, and so far we haven't seen one.
Okay, well, thanks for the update, Erik. Now, this week's feature interview guest is author John Netto. Now, Erik, why did we invite John to the show this week?
Well, Patrick, as you know, John is an excellent macro analyst. He wrote an excellent book with several other authors, which is called the Global Macro Edge and has had a lot of good perspective. And ironically, in this interview, you will hear John predict that Christine Lagarde will be selected as the new head of the ECB. And we found out at the end of the interview, as we looked at the news, that while we were recording this, that exactly happened. So needless to say, he's gotten a few calls right, including one that he made during the interview, which actually came true before the interview was over. So he's a really sharp guy that we've been looking forward for a while to getting onto the program. This episode of MacroVoices was made possible by TopTradersUnplugged.com. Now, although I'm a global macro investor myself, it's long been known to investors around the world that systematic or quant-based strategies are profoundly effective at extracting returns from the market. Top hedge funds like Bridgewater Associates and Renaissance Technologies discovered this decades ago. And there's one podcast that covers this area of finance better than any other, TopTradersUnplugged.com. And right now, MacroVoices listeners can even get a free book explaining how these systematic strategies work. Just go to TopTradersUnplugged.com/macro to claim your free copy. Again, that's TopTradersUnplugged.com/macro. Check them out. You'll be glad you did.
Erik's interview with John Netto is coming up as Macro Voices continues, right here at MacroVoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is author John Netto, author of The Global Macro Edge. John, it's great to have you on the program. I want to start with, usually I ask the question about the issues that I see as the real drivers of the market. Frankly, my question today is, what the heck is driving this market? Because it seems like everybody's obsessed with this Trump-Xi negotiation thing. Frankly, it feels to me like it's produced for public consumption. I think we're going through theatrics here. Is this really about FOMC policy and expectations of rate cuts? Why are we seeing over this last weekend the huge gap up open? What is driving the market, in your opinion, right now, and what should investors be paying the most attention to?
First of all, thanks for having me on, Erik. It's a pleasure to be here. Longtime fan of the show. So feel like I'm in hollowed ground right now. To your question. So I think when you look at the gap up that took place in the S&P from Sunday, from the G20 reconciliation, the Trump-Xi trade talk reconciliation that happened in Osaka, it's more about a quasi-Goldilocks scenario. And I use that term hesitantly because we've heard it when it applies to sort of just inflation is just low enough, but not running away. Growth that's sort of in that 1.5% to 2.5% threshold. No threat of the FOMC coming in and sort of getting in the way, because you're kind of in that area where, corporations can continue to generate profits and cash will remain fairly cheap. So I think while not the quintessential Goldilocks situation, the sentiment, not that I agree with it per se, but being that, okay, the Fed is going to be moving 25, maybe even 50, although 50 doesn't seem like a possibility in July now. But the Fed is now going to be reducing rates. Inflation is in check. The trade war is not escalating. And this is where I think technical analysis can benefit, even in regards of what is the price trend, okay? So was the outcome a base case for a lot of people from the G20 meeting? Absolutely, all right? But if it was a base case with the S&P making new lows or selling off in the throes of a bear market, then your inclination is that the previous price action will resume. Well, we happen to have a market, equity market, risk markets that are near highs. Now, the composition of what has them near highs is a little concerning in terms of the consumer staples and dividend-paying stocks like that, which have led the way up. But looking at the price action of the S&P and looking at no further tariffs were happened as a result of the G20 meeting, at least gave enough factors for S&P to continue not going lower. And so, in which case, what do we have? 20 points or 15 points from the close, from Friday's close and searching the close. So net, that's what I see on the risk side. I think more broadly and more importantly is what has happened since the July 19th FOMC meeting. And a couple of things happened within that statement and within the summary of economic projections, which lent themselves very favorably to the price of gold and really to global yields that are going to keep heading lower. We saw, of course, and the dot plot projections came down surprisingly. I build models that synthetically score FOMC events. And that was, the dot plot movement was definitely a surprise. What was also a surprise occurred in the second paragraph, and this grabbed one of the Bloomberg hot headlines, was the reference to increased uncertainties. Now, in the second paragraph of the FOMC statement, they walk through what their base case is. And of course, up until now, it considered, a return to their symmetric inflation goal and growth as the most likely outcome. Well, the Fed really hedged that statement with a qualifying sentence in the second paragraph, which these qualitative things, Eric, don't necessarily get insta-algoed, into the market. There's a digestion period. And effectively what that qualification statement did, that was, again, another surprise and skewed the statement surprisingly dovish relative to what market expectations were, and really kind of gave the all clear for Canadian dollar, to perform as well as it has been. We have oil rallying, we have Canada looking better. Also, I'm a little surprised with the lack of performance from Mexican peso, but also gave really the go ahead for gold to pop. Gold that night put in a $40 move, within hours of the FOMC statement. Again, sometimes this stuff just takes a while to process. And so for me, it's just the synchronized G3 central bank dovish chorus that has basically said that, which has basically highlighted that growth is going to be an issue and further compounded this chase for yield. And so what does that do? That sends boons higher. And now we're talking about Christine Lagarde potentially being a prospective ECB head. And I think the idea that she's in place or potentially in place would mean a further, 10 or 15 basis point decline on what are already negative yields. I believe I read this morning that 62% of all European debt is now yielding negative rates. So imagine, compounding that even further. So when you look at all this stuff, I think it's very conducive for gold, which is why gold, rallied as high as 1440, gave us a nice pullback. And it really sets up tactically to buy any kind of dip in fixed income. So if there is positive news out of China, out of a trade deal, that's simply an opportunity to buy, because on a more broader scale, global portfolio managers have to own yield that's safe. There's simply not much else to do out there. So that means dividend paying stocks. That means consumer staples. Those guys should continue to perform really well. As ridiculous as that sounds, given where they are in the chart, the macro environment is very much in place for that to continue. That's why I think gold's going to print a $1,500 price, sometime here in July.
I want to come back to that subject, John, of what is going on in the fixed income market. But first, let's go a little deeper on this subject of gold, because it's on so many people's minds. I was really, really surprised before the FOMC announcement and the big move happened. I had Greg Weldon on, who is a very well-known, he literally wrote the book on gold investing and was just uber bullish gold when we interviewed him a couple of weeks ago. To my surprise, I talked to him off the air a little bit after the announcement, and I was expecting him to say, "I told you so, it's headed higher from here, jump on if you were late." To my surprise, what he said is, hold your core position, but we moved awfully hard, awfully fast. I think it's time to take some profits tactically and wait for a pullback. And if you get a dip below about 13.95, it's probably time to get ready for the possibility of a dump and much lower numbers. And I was really surprised to hear that from such a gold bull. And it's not changing his long-term view, but he sees room for this to have been a false breakout that could potentially break down and lead to much lower numbers, or at least that was his view as of a week or so ago. How does that jibe with your view? We've closed the gap now that we saw. If that's going to be proven true, I guess it could be all downhill from here, or it could be all uphill from here.
His view is the antithetical of mine in every sense. Actually, not every sense, but in terms of the tactical sense. And obviously, I have a great respect for his opinion. However, my perspective rests in the fact that we are once again reemerged in a complete debasement of global currencies, or of prominent G7 currencies out there. And we've seen this, naturally Bitcoin has pulled back as well, but we are seeing a migration into gold. We are seeing, after months or even a protracted period of consolidation, that the gold has made a key breakout, having trade gold in the 2000s and in the early 2010s, and then through the ups and the downs of it. With every trade you put on, Eric, it's about what your views are, but then also how you structure it. To me, what's compelling about gold right now is that you can purchase upside optionality on it, which they're at elevated prices over the last 3 years, but they're at much lower prices than what they were 6, 8, 10 years ago. And so he can be right and I can be right because the structuring of the trade, there's value on both sides. I believe there's value in terms of owning gold because I believe it's going to have a 1,500 print on it here in the month of July of 2019. Okay, and I'm saying that as we're at 1407 right now. All right, but I also think that I can own gold via options because I can own 23 days out for 120 basis points for upside optionality. Now, that is a little richer than what it has been, but if we take on a regime or a profile, okay, especially with a non-farm payroll number coming this Friday and a broader chase for yield taking place, the structure of that becomes very compelling and gives me multiple outs. The guy that lives in Las Vegas and is a professional speculator, it can't just be your view, but how are you effectuating that view? How are you executing that view? And for me, controlling risk through options on gold right now, so that if it does turn back around and dump again, we'll at least provide a defined risk point. But everything I'm seeing and the price action around this and how they've bid into this pullback is indicative that we're headed topside.
John, let's come back to fixed income because this has perplexed the heck out of me. I've been saying, okay, we're here at 2%, and we move so far, so fast. There's got to be a pullback. There's got to be a pullback in yields. There's got to be a chance to buy this long duration trade at a better price. It's got to be coming because we move so fast. There has to be a pullback. Well, what has it been, 3 weeks now? And we're almost pinned on 2%. Am I making a mistake to wait for the pullback, or what do you think is coming here? Because I want to be exposed long. I was exposed to the short end of the curve in 2-year futures. I want to be long 10-year futures, but I was hoping for a better price. What should I do?
Take a tactical or a more tactical approach than what you already are. It sounds like you have obviously some aspect of tactical entries into how you're putting this on. I would say that you want to really look at the chart of the 10-year treasuries, like you're saying, like it's obviously a projected uptrend since mid-April, but sentiment has shifted rather violently as well. I mean, let's keep in mind that as of May 3rd, before Trump tweeted out, May 1st, the Fed had and I'm going to give some backdrop here and then get directly to your question, Eric. On May 1st, the Fed had a meeting where Powell referenced, it was more of a hawkish press conference following the FOMC meeting on May 1st. This was Wednesday. We came out Friday, May 3rd, with one of the more bullish and more hawkish economic reports. And sometime, I believe we hit close to 300,000 jobs on the payroll. Sunday night, the tweet war begins between Trump and Xi. This obviously began a pretty dramatic shift in sentiment that coincided with a broader shift in the economic data out there. And that reprice that we saw in May, where effectively, you did see that precipitous decline in 10-year yields, was part of a more natural reprice. And when you get caught in these reprices, Eric, they tend to move pretty dramatically. So the question then to you, and we can maybe go to gold a little bit on this, when you say, well, John, I want to find a spot, I want to find an entry point. I would say that maybe part of your entry point is a derivative trade, which may end up being long gold, because gold is broken out, but gold hasn't seen necessarily the same risk-adjusted appreciable decline that fixed income has since early May. I mean, gold has obviously put in a great move, but maybe playing gold to 1,500 becomes a way that you benefit from this larger, more prolific, more structural central bank accommodation flattening yield curve. And that's something to sort of keep in mind, that it's not just with U.S. Treasuries. I'd also say that, markets are a function of a lot of noise. They're a function of rebalancing. So as fixed income does better and there's a little bit of rebalancing going on, it's measuring how that rebalancing and measuring how maybe a headline can influence things. For example, this Friday we have a non-farm payroll number. Maybe it comes in a little stronger than most are suspecting. That strength is large. Should it come in stronger, to me, is largely inconsequential to what the Fed does. Maybe even on the Fed decision, Jerome Powell speaking on July 11th, he may make some comments that cause people to square away some of their positions beforehand, at least square away their positions before that happens, or subsequent to those comments. None of those, or very few of those things, are going to derail what's happening in this fixed income rally right now. All right. And as a result of that, this chase for yield, which is happening at $1 trillion level, you get these tactical pullbacks, Eric. That's where you step in and buy it, and you work these thresholds, and then you play these balances back, and it's been a very reliable trade, and I think that's going to continue.
Let's talk a little bit more about what to me is an unobvious aspect of the drivers for this widely expected Fed rate cut. The usual story, at least for the last few years, has been, okay, it feels like the stock market is on the edge of crashing and the Fed's got to come to the rescue and a rate cut is always the way to save the day. Well, clearly, that's not the situation or the setup here. We've got the S&P literally at all-time highs or within a few points of all-time highs. So that's not the driver. Why is it that now is the time that the Fed has to cut rates? What are the things that are causing so many analysts to conclude that it's nearly inevitable that there's going to be a rate cut?
Because, well, the obvious answer is because the Fed has told us, okay? And there's a historical, they're pretty reliable that if the Fed funds futures are above 30% going into a rate hike or going into a rate decision, either a hike or a cut, the Fed does that. What the Fed does not do, Eric, is surprise the market. Okay, so the first reason is that the Fed believes, based on their own internal analysis, all right, based on their own process, that it is appropriate to cut rates. So let's just start with the big picture on that. And we know that through their communication mechanism, when they lay out a framework that says we're going to make a policy decision either one way or the other, or none at all, whatever message they give to the markets and that gets priced in at above a certain level, that is what happens. Okay, so that's number one as to why we are going to cut in July. Okay, now taking a little bit of a deeper dive, when the Fed did their first rate hike back in December of 2015, the 5-year Treasury at that point in time was sitting at 175 basis points. All right, and it's a good rule that when the Fed rate hiking cycle would finish, it would match up to where the 5-year Treasury yield was at the time that the cycle started. Well, we went about 75 basis points above that, or at least 20 or 50 to 75 with a lower bound, upper bound dynamic with a 225 to 250. And to me, and to a lot of people as well, some maintenance cuts to return us back to there, especially given that they, at least on the guys that want to reach their symmetric inflation target, is defensible. And given the slowdowns we've seen globally, the global PMIs that we've seen, it really is a question of 25 or 50. Now, again, I talked about the surprise factor. If we're at 50 basis points is almost negligible, is a very small shot right now, we're going to cut 25 in July, and we'll see what they lay out for the rest of the year. But I think we're cutting 3 times this year and on track to cut another 2 or 3 times next year.
John, I also want to touch on the Mexican peso. What's going on with the price action there?
To my surprise, the Mexican peso has not responded as well to the Fed decision that took place 2 weeks ago. I actually think that when you look at, again, what the narratives are out there, the yield paid by the Mexican peso, the fact that it's on our border and sets up for a situation where I think the peso could get back to multi-month highs here relatively quickly. And I think what's also unique about the peso is that its purchasing optionality on it is not that expensive. And obviously, there's a different level of emerging market risk that goes with that. But if I'm, as bullish as I am on gold, and I think that the Fed is cutting to the extent that it is, and I see this global chase for yield that we've talked about, looking at Mexico now clearly when we talk about a global chase for yield, there's some hedging costs involved, but 850 basis points for owning Mex, energy prices that are rising, we work out a trade deal that seems to suggest that that's going well, and just sort of like in an obligatory way or in a derivative way, that this Mexican peso turns around and we see it, appreciate rather considerably over the next even 90 days, And I think that us going back to the 186 level is a real possibility, even the 185 level by Labor Day. I'm speaking USD MXN on that. I'm getting back to down to 185.
John, I'd like to shift gears now and step back to the bigger picture because I wanted to start with some tactical issues because everybody's so interested in what's going on in the market. But a lot of what you're known for is your book, The Global Macro Edge, and the whole approach that you take to global macro investing. So why don't we start with the Netto number? What's the Netto number and how did you come up with that?
Sure. The Netto number allows me to measure the performance of a stock, a market, a portfolio, a strategy on a return per unit of risk basis. And that's critical because a lot of mistakes that investors have made, that I have made, have come from only having a one or even a two-dimensional perspective on the market. So when we talk about three-dimensionality, well, let's talk about what one-dimensional performance assessment entails. So at the one-dimensional performance assessment, it might be, hey, Eric, how much is gold up today? Gold's up 1%. All right. Well, what's lacking from that, Eric? Well, we know it's up 1%, but we don't know how much it was down. We don't know was it up 7%. We don't know how much one had to risk coming into the day to make that 1%. Okay. So let's go to the second part of that, which is pretty common amongst institutional circles. You'll see it on a manager tear sheet, which will be, okay, what is the risk-adjusted return of gold today, or of gold for the year, or gold for the month? And you'll hear terms like a Sharpe ratio, or a Sortino ratio, or a Kalmar ratio, which helps measure gold relative to the realized volatility it has. So if gold, is trading at a 1% standard deviation on a daily basis, and it makes, 50 basis points, well, that's cool. But it's more impressive if gold, makes 50 basis points, but only has a 30 basis point standard deviation. And so that comparison helps out. However, what the Netto number does is it takes a predefined risk budget. So for a manager, if I say, Eric, I'm going to give you $1 million, all right? But if you lose $200,000 of that, okay, that's your risk budget. If you lose $200,000 of that $1 million, I'm going to stop you out. Another investor says, well, I'm going to give you, John Netto, that same $1 million, but I'm going to give you a $400,000 risk budget. Well, at the end of the year, Eric, you made 15% on that, okay? And I made 15%. And we had similar drawdowns and a similar Sharpe ratio. But the one thing missing, and this is what hangs up investors so much, is, Eric, you only had a 20% risk budget. You can only lose $200K, while I can lose $400K. And so that flexibility premium, that risk budget that went in, is that third dimensional component that isn't known by many investors and is not commonly used. So what I do when I measure performance of markets, when I look to assess where money flows are going, when I look to assess opportunities of a strategy, is I take the Netto number and measure, okay, I want to take performance and measure it against a risk factor. And so the risk factor consists of the size of that risk budget, which in your case, in that example I just showed, would have been $200,000, plus the volatility associated with those returns. Okay. And so I take those two, I equally weight them, and then I take the average of them. All right. So now all of a sudden, I've rewarded someone that manages, that keeps volatility down while making money. At the same time, I've also rewarded someone who does well to, in essence, make more by risking less. Okay. And so the Netto number divides the performance by those two components. And it's obviously elaborated on in my book, and I'll stay away from abstract mathematical formulas on your podcast to be gracious to your listeners. but that at its essence is how I begin to assess the macro narrative. Because, if we talk about China trade talks, or we talk about what the Fed is doing, to me, it ultimately filters down to how you can synthesize that information into something that's actionable. And so I can say that this macro narrative is in fact what's leading things. But if I don't have the Netto number or the equivalent Netto number demonstrating to me that is in fact the narrative, then that's something that I'm going to take a back seat to. So when we go through repricings of markets, or when the macro narrative changes, all right, that's where you can combine both the quantitative studies, which are things like the Netto number, and I have other unit of risk ratios like the agony ecstasy ratio, which measures how much a stock was up on the day versus how much it was down from its previous net change. I have the impact ratio, where I measure how certain events impact certain asset classes and how that can affect a risk budget behind things. And then ultimately what I do is, let's just say, I'm a money manager, I'll use the Netto number to determine how much compensation I should get. So the higher the Netto number, I would say in your case, Eric, in our situation again, you would actually be entitled to, if you made 15% and I made 15%, you would be entitled to a higher percentage compensation because you made more with less risk. And so when people talk about, oh, I run this strategy and I'm this great trader, it's like, great, let's figure out a way to create a goal congruent compensation structure that rewards managers when they maximize return punitive risk, which is the subtitle of my book, The Global Macro Edge, Maximizing Return Punitive Risk. Let's have a way that doesn't reward them when they don't. If you go and take a big shot, you take a big bet, okay, and you win, that's not as impressive as if you take a small bet, but you manage to parlay that small bet and generate the same returns. And so the Netto number and the risk factor compensation system account for that, and that's a big part of how I conduct my macro analysis.
John, I want to go a little deeper on this because, quite frankly, having run a hedge fund and having met some other people who have run hedge funds, I personally have become pretty cynical about Sharpe ratios and Sortino ratios and all of these other hedge fund risk metrics because I know what really goes on is these are numbers that are tracked based on monthly closing performance. And I've met plenty of managers who have had absolutely crazy risk excursions that happened intra-month, and they didn't close the month with anything close to the crazy 45% drawdown that they had on the 12th of the month, and nobody ever finds out. And it seems to me that these risk metrics that are only calculated from monthly numbers are almost completely irrelevant. Now, what a lot of people are doing, at least a lot of very sophisticated institutional investors, are they're insisting on separate managed accounts for this reason, so that they can see the daily volatility as opposed to just monthly. Is there a reason that investors investing in managed funds, whether it be a hedge fund, managed commodity pool, or whatever, should take things like Sharpe ratios and Sortino ratios, which are only represented on a monthly basis, seriously? Am I missing something there?
Listen, let's talk about the good and the bad because you hit on a lot of great points. And the two main points you hit on are, one, the limits with the Sharpe and Sortino ratio, and then two, the granularity and the temporal aspect with which you receive investor data. Okay, so there's two aspects to that, and I can speak extensively about both of them. The first side about the Sharpe and Sortino ratio of why it is limiting from a monthly perspective is everything you just mentioned. The fact that it misses so much is limiting, but it's also why you need to have a risk budget in place because that at least gives you some semblance of security that this person was trading with a risk budget. So a Sharpe ratio of 1.6, while Eric was running, like, let's go back to the example of your $1 million allocation that I gave to you, okay, with a $200,000 deal. One, if I know that your Sharpe ratio, even on a month-on-month close, is a 1.6, but I know that the entire time, Eric, you were managing it around a risk budget, that Sharpe ratio has a little more credibility to it, okay? Because you never were down, like you never blew through your risk budget in the first place. And so that's why that lack of three-dimensionality is such an issue. Because let's take something like the kind that you and I love so much, are the option selling strategies, okay? And you see investors see these incredible returns month after month, allowed to make these returns. But they're not asking the right questions, Eric. They're not putting the returns in the right context. How much were you risking to generate those returns? And what the Sharpe ratio doesn't do, what the Sortino doesn't do, it doesn't ask those questions. It gives you a performance relative to realized volatility on a monthly basis. Okay? So if you generate, a 2 Sharpe, but in order to generate that, you had to put 70% of your portfolio out there at risk, or in the case of, risk $700,000 in a potential XIV moment, if you will, well, then it doesn't give investors that granularity. It's a lot like a sailing map used 400 years ago. Okay, if you looked at it, the size of Greenland looked like the size of North America, but that's not true because it didn't have the right dimensionality behind it. Yes, you can generate 20% returns, but I was literally selling, 10 delta options for 3 years in a row until one day I lost it all. So without having that risk budget as a context, that three-dimensionality, the Sharpe ratio and Sortino ratio are very limiting, and that's why.
John, in my opinion, we have an epidemic in institutional finance, and it's an epidemic of understanding what risk really is. And you mentioned an XIV moment. Before the vol complex ever blew up, I remember going to institutional conferences and talking to people who should know better, fund managers, saying, look, these guys on this short vol trade are crazy with the risk that they're taking. And I would have people who are fund managers interrupt me and say, you don't know what you're talking about. That's a low-risk strategy. Just look at the Sharpe ratios these guys are delivering. And it's like, dude, you don't get it. You don't get it.
I know, it's ridiculous. It's ridiculous.
And to me, there is this really huge problem, which is we've got this academically prescribed model where the reason that volatility is perceived as a meaningful proxy of risk is based entirely on this conceptual idea of evenly distributed normal returns, which is not the way the real world works, despite what academic finance thinks. And so what you end up with is these guys who really believe that these risk models accurately measure risk. And, one of the most famous things, the guys that are just selling, they lever up these strategies to sell out of the money calls and puts on the S&P because they know that they're going to make a lot of money in their own pocket before the day comes that strategy blows up and they lose all of their investors' money. And the people that are evaluating these things, professionals, that's their job, are saying, well, look at the Sharpe ratio. It looks great. There's not a lot of risk here. And they don't think through where the real risk is because they don't understand that this business of volatility equating to risk is entirely theoretical, and it's based entirely on normal distribution, which is not the way the world works. Does the Netto number make a meaningful inroad into solving these problems?
Yes, because what the Netto number does is what a Sharpe ratio measures performance relative to realized vol, the Netto number measures performance relative to implied vol. Okay, so we think about how, going back to the institutional case you just brought, a lot of institutions, when they allocate, will assess what's called a volatility target. Okay, where they give a manager, now by the way, that doesn't insist that a manager adheres to that target, but that's quote unquote what the target is. So I give a manager, okay, your vol target for the year is 12%, your vol target is 16%. So if we back this out, whereas the Sharpe and Sortinos measure performance relative to that realized vol, the argument to have with those guys at that conference is, well, guys, the mistake you're making is that you're measuring performance relative to realized vol when you should be measuring it to implied vol. Now, we go one step further with the Netto number because it puts an actual hard budget there. Because back to your point, what the academics do is send this sorrowful letter about how somehow, Eric, can you believe their model experienced a 1 in 10 million event when the XIV moment happened? That's only supposed to happen once every 17 million years. But apparently now it happens every 4 years. I don't know what happened, okay? And so the risk budget acts as a real world braking system for a portfolio manager. And the Netto number catches that because by having the braking system in, it limits your flexibility. But that's okay because that's real. Because as managers, Eric, when we lose money, we have to tighten our belts. We have to trade within that budget. Households have to spend within a budget. The government, well, they don't spend within a budget, but we have to spend within a budget in the real world. And so why should a manager have to manage risk within a budget? And the Netto number tells you how well a manager does that. So you can still sell option premium, but the risk budget, the Netto number is going to capture how much of your portfolio you have to risk to do that. And as a result, you can actually say, oh, so your Sharpe ratio is 2, but your Netto number is only 0.6. Well, that tells me that, yeah, you had great returns, but man, you had a lot of risk out there. Or your Sharpe ratio is 1.2, but your Netto number is 2.7. Wow, you made some great returns relative to the small risk budget I gave you. Because we're in the business, Eric, of risking less to make more.
Well, John, I'll just correct you that event on the VIX was, in fact, a million-year event. It was impossible for anyone to have seen it coming. I've been assured of that by lots of people. And the fact that 3 separate MacroVoices feature interview guests saw it coming and predicted it within 6 months of it happening was just pure coincidence. I'm sure of it. Anyway, let's move on in the subject of academic nonsense, and there's plenty of it. One of the things that is taught is this whole idea of rational expectations theory and efficient markets hypothesis. Nobody in the professional finance community ever allows their emotions or human factors to get involved, and psychology doesn't enter the market according to a lot of academic models. I'm sure you know where I'm going, which is Chapter 19 of The Global Market Edge. Talk to us about traders and psychology.
Sure. So as a person that uses both quantitative tools and qualitative tools, I rely very heavily on my ability to use a skill known as cognitive empathy, or to, in essence, think about how other people will likely behave in a situation and to feel what other people may be thinking or feeling. And so I have spent an exhaustive amount of time, over 15 years, journaling and building to weaponize my emotions for the purpose of creating more robust trading signals. So what do I mean by that? I actually spend a lot of time journaling my emotions when I'm trading because I incorporate them into what I do. So if I'm feeling particularly fearful or if I'm feeling particularly complacent, these in and of themselves can be signal sources for me on top of that. And so let's just take a step back for a moment. It was important for me when I wrote the Global Macro Edge, Eric, that if people were going to spend, the kind of time and money to read a 600-page book, that they knew that the people who wrote it, myself and the other contributing authors, were actual successful practitioners. So what I did was hire a CPA to come in and verify my trading P&L. And effectively what he did was show that from January 1st, 2010, up to when the book had to go to press, which was December 31st, 2015, before we sent it off to the press, I took a $100,000 account and I generated $3.1 million in P&L over that 6-year period. By any metric you use, those sort of returns are pretty profound and pretty compelling. So what I'm telling you now about the intuition infrastructure was a key component. It was integral to generating those returns, along with the other stuff I've shared with you. But that intuition infrastructure, that understanding of when the market is at a sweet spot and what I like to call the factor, like when you have these butterflies in your stomach, you're in a position, those butterflies, Eric, are a real signal, okay? That complacency when you feel, like, have you ever noticed when you get into a trade and you feel really good about it and you start eyeing all your friends, like that pretty much marks the high tick if you bought it at that point in time. Like it's almost destined to not work out for you when you can confidently and exuberantly say, hey, my goodness, look at this trade I just bought. The other day, actually, I saw when Bitcoin hit like 13,500, I believe, one of the Winklevoss twins tweeted out about it going to the stratosphere, the metasphere. That was actually when you feel confident enough to exhibit that much enthusiasm, that much unbridled enthusiasm about a particular market, those can be very powerful sentiment indicators. And so how do we internalize, how do we harness, how do we memorialize those sentiment indicators? How do we incorporate that into what we see? And so all of chapter 19, with Denise Schultz's help, she wrote Market Mind Games, very prominent performance coach in the hedge fund industry, and helping people really take their emotions, use that intuition on top of, all the hard skills that are necessary to be a great trader to succeed.
Now, I want to go a little bit deeper on this because, there's an aspect of this which is using these signals to gauge what might be going on inside of one's self. I know Rick Rule is famous for saying, if you're feeling smart, really smart, sell. It's time to get out of that trade because you've already had your success. And I guess there's another aspect to it, though, which is, do you use these signals based on your own feelings in order to gauge what the rest of the market is feeling, or do you only use it to gauge your own personal mental condition relative to your own trades?
A little bit of both, and let me elaborate on what I mean by that. I spent a lot of time canvassing my network and trying to form a consensus of what the market is thinking. So, for example, the Federal Reserve meeting 2 weeks ago, I'd formed a consensus, from a pretty crystallized view of what was expected to come out from both the dot plot and the composition of the statement. And so the sentiment and feeling I get is relative to what the market is expecting. Now, I have my own internal feelings as well in terms of I just bought this or just bought that. But the first point of origin, the first point of reference, I should say, is how is the market responding to this? And that's where I go back to the whole cognitive empathy thing and the whole intuition thing. It's like, wow, the market was not ready for that qualifier in the second paragraph when it described that uncertainties have increased about this most likely scenario happening. And the market was not ready for such a dramatic drop in the dots for 2019 and 2020 and the downgrades to the inflation forecast. So at first is refracted through that lens of, okay, how is the market feeling about this? Now we get into more tactical situations of like, how, am I becoming complacent or brazen about a position? And that feeds into still some of the more management styles as well. So it's a combination of both, but that's what I'm looking for on both sides of it. So I have my own internal thing, what I'm doing, but also it starts with what the market is doing and how the market should respond to this. And from a temporal perspective, when the market will respond to this. Like I said, some of this takes time to process and filter. They just simply, portfolio managers can't process this and allocate the kind of risk to this in an instantaneous manner. It takes days, even weeks, to truly work its way in sometimes.
John, I could go on for hours about this stuff. Unfortunately, we need to leave it there. But before I let you go, I want to ask you on Sunday, July 21st, you and Patrick Ceresna, my co-host, and our good friend Kevin Muir are all going to be traveling to Chicago for an event called Traders Expo. And you're actually running a series there tell us about what you're doing, how Patrick and Kevin fit into it, and how people who are interested in attending can find out more information.
Sure. So on Sunday, July 21st, we will continue an ongoing series that has happened in New York, in Las Vegas, and now in Chicago that is put on for free. It's part of the Traders Expo. It begins at 9 a.m. Chicago time on Sunday the 21st. It goes to 1:30, and it's very much, I'd say, emblematic of MacroVoices itself. You know, we believe that we live in an era where there's more information available to a more diverse group of people than at any point in time in the market's history. And for those of us that do this for a living, this is our way of giving back. And we believe in investor empowerment, as does the MacroVoices show. And so that's an opportunity to do that. In particular, you just mentioned Patrick and Kevin. They will be having a bull bear smackdown where they will be sharing different opinions and different ideas about why stocks can go up, why stocks can go down, why bonds can go up, why bonds can go down. And I will be emceeing that event. And so when you look at the substantive content that we shared on today's show, imagine how that spread over 4.5 hours. And so for us, it's critical that we can share these ideas, share these approaches, share the processes so that investors can now take them and apply them to their own portfolio, to their own investing. And that, in a nutshell, is what the series is about.
And John, before I let you go, give us your Twitter handle. And for people who are interested in learning more about your book, The Global Macro Edge, please tell them where they can find it.
Sure. My Twitter handle is @John Netto, @JOHN, and as Nancy ETTO. And the Global Macro Edge, the link will be available on my Twitter handle. Find on Amazon, order on Kindle, and would appreciate any interest you have.
Fantastic. Well, I can't thank you enough for a fantastic interview, John. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have John join us for the interview. Now, I just wanted to point out that he's mentioned that he's going to be in Chicago, and myself and Kevin Muir are going to be a part of the Trader Expo, having the big bull-bear debate on bonds and stocks. But what he didn't mention, and which is an invite that is open to all of our listeners, that if you do come after the Macro Edge series event that is occurring, we're all actually going out for some drinks at a pub nearby. And it's free to join. I'd love to meet all of our listeners. So anybody that wants to join us afterwards is also welcome. Anyway, Erik, what did you take away from the interview?
Well, you know, it's such a pleasure to talk to someone who can see through the BS of academic finance. All these Sharpe ratios and Sortino ratios, they're true to the extent that the underlying assumptions are true, and the underlying assumptions are not true. Investment returns are not really normally distributed, and volatility is only an indirect proxy for risk at best. So it's a real pleasure for me to talk to someone who sees through this stuff and sees as clearly as I do that the industry deludes itself with a lot of these numbers that supposedly tell you so much about the risk-adjusted returns of investment funds. And again, when this stuff is being measured on its monthly volatility, it doesn't tell you what happened intra-month. And believe me, I've heard lots of stories from fund managers about crazy things their investors never found out about because it happened intra-month and they managed to make a Hail Mary trade and make back their loss and nobody found out what happened. There's more risk in hedge funds than meets the eye from some of those ratios.
All right. Well, listen, in the market wrap, you mentioned this big polar difference between the views of Danielle DiMartino Booth and Brent Johnson. So, Erik, what's on your mind here?
Well, I think that the contrast between Danielle and Brent's views really, to me, epitomize what you need to think about in order to understand this stock market. What Danielle is saying is, look, there are just such clear signs of a global economic slowdown. So far, the rest of the world is feeling it really badly. The U.S. hasn't felt it in its markets yet. The U.S. cannot be immune forever. What's happening to the rest of the world is coming here. Don't delude yourself. It has to hit. What Brent is saying is almost the same thing, which is it's hitting the whole world, but you know what's going to happen is we're going to see the U.S. become a safe haven trade because European bonds are so ridiculously overpriced in negative yield territory that they're not going to provide the safety trade that they normally would. And what will happen, especially if the U.S. dollar continues to appreciate, is that the European safety trade will be into U.S. stocks because European investors will correctly recognize that in an uptrending dollar situation, they get both a stock market benefit as well as the foreign exchange benefit of being in a dollar-denominated asset. And Brent thinks that despite the fact that what's really happening is worsening fundamentals driving this, that the result for U.S. stocks could be much higher. So it's a really interesting contrast. And, it's something I see, too, in the data. If you look at the University of Michigan Consumer Confidence, it's off the charts to the upside. And I'm seeing this myself. I have my vacation home on the coast of Maine on VRBO, for vacation rentals. And for the first time ever, first of all, we're booked completely for this season, with the exception of the week leading up to Labor Day, which is usually it's an anomaly because it's usually one of the most busy weeks of the year. We've only got 1 week that isn't booked this year. The rest of the season is booked. That's unusual. But what's really just completely unprecedented is we got half the season booked next year. And normally we don't get any bookings on vacation rentals, at least my vacation rental, until, October, November. People are thinking about planning ahead for next year maybe, but certainly not this early. So it says to me that consumer confidence is really strong. People are planning their 2020 vacations already. Yet if I look at what the bond market is telling me, it says that we're headed straight into a recession. They can't both be right. So I'm seeing signs everywhere that there's this big dichotomy of views that can't both be right. It has to get resolved one way or the other. And what I'm coming more and more around to is the Brent Johnson view, which is, even though I am absolutely irrevocably convinced that this is bad economic news, that's really what's happening here, I think the bad economic news in a bizarre way could drive the U.S. stock market much higher for the reasons that Brent has described.
So, Erik, why don't you do a shameless plug for the URL for your VRBO?
That's good. Well, we're looking for sponsors. This episode of MacroVoices was brought to you by vrbo.com/1498342. Eric's house in Maine. But if you want to book it, email us at info@macrovoices.com. Don't pay VRBO a commission. We'll give you a discount. Seriously, though, it is unprecedented to see. I've had this house rented for like 5 years as a vacation rental. We have never seen the next year book out. And we've only got the week up to Labor Day left this year. Don't bother inquiring for this year. It's sold out. It doesn't happen. Well, actually, that's not true. It's not sold out after Labor Day, but the season, the busy season is until Labor Day. And with the exception of that last week, it's already sold out. I've never seen it happen before. And the other thing I want to mention today is we do have a new video at macrovoices.com with a full update on the digital currency situation. Now, as a lot of our listeners know, I am not a huge fan of cryptocurrency. That's really not what the video is about. I'm explaining why I think Facebook's Libra announcement, the Libra currency, which the Congress has now asked Facebook to stop development of. And I think that makes lots of sense. It is a real risk to humanity as far as I'm concerned. I think Facebook has designs on doing all the wrong things for the wrong reasons. Anyway, there is an update on my outlook for what's coming next in the digital currency revolution. It's not just more of this cryptocurrency, Bitcoin stuff. And I think that it will interest a lot of our listeners. You'll find a link to that in this week's Research Roundup, and it's also on our homepage at macrovoices.com. But in any case, Patrick, I want to get to the Postgame chart book. Listeners, you'll find the download link in your Research Roundup email. If you're not yet registered, just go to the homepage at macrovoices.com, click that red button that says Looking for the Downloads. And what we see here on page 2, Patrick, is the S&P 500, and it only shows 2996 on this chart, which was snapshotted just before we recorded today. But as we are speaking, we're looking at 3001 on the S&P, and probably a good chance that we'll close above 3,000 today, and needless to say, that is a very bullish indication.
Absolutely. And what I just wanted to do on this chart was highlight the fact that 3,000, while everyone is caught up on the round number of this 3,000, it's like a big mile marker for the S&P. But as a technician, there isn't a lot of relevance to 3,000 beyond the round number. In fact, almost all the major measured moves, and that indicates that this kind of a breakout can easily still run 100 to 150 S&P points higher. And so all I wanted to just show with this chart is the fact that it's now far beyond that of just the round number.
Patrick, I agree on the round number aspect of this, but also the breakout to new highs, first of all. And there's also, as a debatable issue, you could almost say that there's a cup and handle pattern here on the chart that would be very bullish. Now, normally a cup and handle has to have a rounded bottom. This is a V-shaped bottom, so maybe it doesn't count. But as I look at this chart, it looks very bullish to me. And that's totally at odds with my fundamental view of what would normally happen in a normal economy. But I think this market is operating on alternate logic that has to do entirely with what we can expect in terms of monetary policy.
Absolutely. So I wanted to move on to chart 3, where I just put on a chart of gold. And what I thought was also interesting was John obviously mentioned 1,500 for gold. And what was interesting is that if, in fact, the flagging formation that gold just pulled, if we did see a break to a higher high above 1,440, a number of the measured moves do actually clear 1,500. So there is some technical aspects that support John's view that gold could go up there. That's why I'm going to be watching whether or not gold can actually break to a higher high.
I agree with you. As much as I really feel like there are still reasons to question, is it possible? It seems most likely that this breakout is real, but I think it's a little bit too early to say that the jury is completely in. This is, resistance has been in place for 5 years. Maybe it's a false breakout and we're going to actually retrace lower. You break to a new higher high from where we are now, it's awfully hard to stay on that story. You really just have to throw in the towel and say, okay, I was just plain old wrong and we're moving higher on gold. And it's looking more and more to me like that could be the case. But as I say, it didn't look that way until this Judy Shelton news came out. And I don't see the fact that President Trump tries to appoint somebody who will probably never be confirmed to the Fed who happens to believe in gold as reason for the price of gold to move higher. That seems to be the driver.
All right, well, let's move on, because on charts 4 and 5, I just had to bring it up. Like, how can we not be talking about what's happening in those yields in Europe? And I highlight on page 4 the 10-year German government bond yields down near minus 40 basis points. It's unbelievable. And what's amazing to me is that that's all-time lows for the yield on the 10-year. And there is no crisis from which this is happening. It's obviously there's buying by central banks and other things, but it's just, I find it fascinating that this is happening. But what's even more fascinating is the dramatic move we're seeing on the 10-year Italian government bond. There was that whole news that the European Commission decided to avoid disciplinary action against Italy over its soaring debt and growing deficits. And Italian government bonds just went soaring, and the yields collapsed. I mean, I think the spread now between the 10-year Italian and German has narrowed less than 2%. So just extraordinary bond moves going. I mean, we thought the U.S. bond market was on fire, but you just go right now to Europe and things are really moving there.
And, Patrick, it's something I've said many times before, and I really wonder if regulators and central bankers are thinking as much about this as they should. We're moving into pretty serious negative interest rate territory on the German Bund. at some point when you really get significant, substantial negative interest rates, it creates a cash hoarding incentive that literally puts the entire global fractional reserve banking system at risk of a run that could turn into a global panic that crashes the entire international monetary system. Now, in order for that scenario, that doomsday scenario to occur, you'd have to have negative interest rates, not just on German bunds, but on a lot of different instruments, and they'd have to be more negative than they are now. But look at the trends on these charts, Patrick. It doesn't have that much farther to go before you get to that scenario. And again, just to explain, in case the rationale for that is not clear to everyone, the reason here is when you get to negative interest rates, it makes more sense for the investor to buy a safe or a vault and just take your money out of the banking system and store the cash in a vault, because you do better that way than tolerating negative returns on keeping your cash in the financial system. The problem is, the way fractional reserve banking works, everybody can't take their cash out. It would crash the whole system. There's not enough. It's the reason it's called fractional reserve. We don't have enough reserves for everybody to take their money out. And what we're doing through policy is we're creating a financial incentive for people to do exactly that. That financial incentive doesn't really kick in until we get more substantially negative interest rates. But look at the trend here. It seems like it's coming. I haven't heard anybody talk about what the plan is to prevent that run on the banking system if we were to get to sufficiently negative rates that it motivated large investors and large institutions to simply take their assets out of the financial system. And one final note, Patrick, just some feedback that we've gotten from listeners. It seems like not everyone understands. We know that it's a real pain in the tail to have to go to our website and get the download, and you've got to navigate to a lot of different places. The reason we provide the Research Roundup email is it gives you everything in one place. You get an email every week that's got a link to play the podcast. It's got the link to download the handouts. It's got the link to any supporting information, and it also has links to all the other free cool stuff that we could find on the internet. So if you're finding it frustrating to deal with having to jump back and forth from the podcast to the internet and everything, we really do have a solution for you. It's called the Research Roundup email. You can subscribe by creating a free account at MacroVoices.com. Today's episode of MacroVoices was made possible by Top Traders Unplugged. Don't forget to go to toptradersunplugged.com/macro to claim your free book and subscribe to their podcast as well. For information on your company sponsoring MacroVoices, please visit macrovoices.com/sponsor info. And again, in order to make this whole process simple so that you've got the podcast, the downloads, and everything in one place, what you want is to register your free account at macrovoices.com. It only takes a few minutes, and the benefit is you'll receive our Research Roundup email, which makes all of this easy. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview as well as a link to the chart book we discussed in the postgame. There's also an interesting article from Bloomberg that emerging market investors will need more than a truce to turn bullish, and a Financial Post article on why Canada won't necessarily follow the U.S. rate cuts. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.